Happy Monday, Tech fam. Welcome to the Tech Stocks Daily Podcast. Today we've got a can't-miss lineup. Accenture's digital power play and jaw-dropping returns, Oracle's sky-high upgrades and blazing cloud growth, Microsoft's Copilot Tsunami and blockbuster efficiency gains, and Apple's iPhone 16 pre-order slip that's shaking up the market. We'll dive into why Oracle might just be your next best buy and what's causing all the buzz. Stay tuned for another action-packed, tech-filled episode. All right, tech enthusiasts, buckle up because today we're diving into why Accenture PLC is making waves in the investment world. First off, Accenture's doing some impressive numbers. Over the past 3 months, Accenture stock has risen a whopping 22%. To put that in perspective, it's outperformed its industry's 14.9% growth and absolutely crushed the S&P 500's 2.4% uptick. Talk about putting your foot on the gas. Now, it's not just sheer luck that has skyrocketed Accenture's stock. It's all about their strategic game plan. Accenture focuses on building a robust digital core using cloud, data, and AI technologies, which positions them pretty snugly for long-term growth. I mean, who doesn't want to hang out with a tech-savvy buddy? They've also got a pretty sweet piggy bank to play with. At the end of Q3 fiscal 2024, Accenture's cash and equivalents were at $5.5 billion with a teeny-tiny long-term debt of just $69 million. That's like having all the cookies in the jar and owing nothing to Cookie Monster. Their stellar cash flow lets them invest wherever they see the most potential, and they're doing it. Last fiscal year, Accenture shelled out $2.5 billion across 25 acquisitions. This isn't spray and pray, it's disciplined targeting in high-growth areas, adding depth to their industry expertise. And let's chat about dividends, shall we? Everyone loves some good old shareholder returns. Accenture has been dishing out consistent and increasing dividends, with $2.8 billion paid in 2023, following $2.5 billion in 2022 and $2.2 billion in 2021. So if you're an investor, that's a steady cash stream flowing your way, folks. It's almost like Christmas every quarter. The cherry on top, Accenture checks all the right boxes according to Zacks rank number 2. This grading isn't handed out willy-nilly. It highlights a company's strong fundamentals, and Accenture's got them in spades. Furthermore, tech titans like AppLovin, Climb Global Solutions, and HNI Corporation are also getting nods, sporting Zacks ranks of number 1. These companies have shown some jaw-dropping earnings surprises in the past 4 quarters. Accenture, paired with those success stories, paints a rosy picture for investors itching for growth stocks. But wait, there's more. What if you had invested $1,000 in Accenture 10 years ago? Hold on to your keyboards because that investment would be worth a remarkable $4,370.40 today, a solid 331.74% gain. In comparison, the S&P 500 and the price of gold have seen increases of 183.35% and 100.86%, respectively. Accenture has built solid client relationships with a portfolio that reads like a who's who of the Fortune Global 500. Their capacity to predict and capitalize on significant market trends, all while keeping the acquisitions train rolling, has established them as a powerhouse. Yet, it's not all sunshine and rainbows. They do face formidable competition from companies like Genpact, Cognizant, and Infosys, which keeps the pricing pressure flag waving. So there you have it, from dividends that make your bank account smile to a strategic growth plan that's nothing short of inspiring. Accenture's got a lot going for it. If you're in the investment game, you might want to keep an eye on this tech giant. All right, tech aficionados, Oracle is having a bustling day in the media spotlight, so let's break down why this tech behemoth is grabbing the headlines. First off, Oracle stock has been on an upward trajectory, riding high on a wave of positive reviews from Wall Street analysts. Seriously, who knew stock prices could get such high praise like movie stars? Recently, Melius Research upgraded Oracle from a hold to a buy, citing their blistering revenue growth and rock-steady margins. To spice things up, they upped their price target from 155 to a whopping 210. Yeah, that's a 22% jump, baby. Over the weekend, Jefferies also wanted to jump on the Oracle love train, raising their price target from $170 to $190 and holding on tightly to their buy rating. Analyst Brent Thill chimes in, saying Oracle's getting its mojo back. Well, it seems like Oracle is not just back. They're ready to take the throne. And it's not just analyst chatter puffing smoke here. Oracle's recent fiscal first quarter earnings report showed some real muscle. Their cloud infrastructure business is on fire, up 45% to $2.2 billion, and overall revenue hitting a solid $13.3 billion with a 7% boost. Oh, and their remaining performance obligations soared 53% to a chunky $99 billion. Clearly, customers are lining up like it's the latest iPhone drop. Adjusted earnings per share rose by 8% to $1.39, indicating margins are flexing stronger than ever. But wait, there's more. The options market has been buzzing with Oracle activity. Our analytics sleuths at Benzinga found a flurry of bullish moves, with 39 unusual trades spotlighted. Cue the dramatic music. Of those, 53% were bullish, and major market players have zeroed in on a price range between $130 and $230. If that sounds like Greek, just know it's Wall Street's way of saying Oracle's future looks bright. Oracle isn't just flexing financial muscle. They're also tech veterans, innovating at the speed of the cloud and AI era. For those who may have forgotten, Oracle is the OG of database technology and ERP software, with 430,000 customers in 175 countries and over 136,000 employees holding down the fort. Finally, let's not overlook the fine folks at Zacks, who gave Oracle some extra love. They pointed out that this software giant is trending in all the right directions. Oracle's shares have surged by 17.9% in the past month, putting the S&P 500's 3.7% gain to shame and beating out even the Zacks Computer, software industry's 4.6% rise. Expecting Oracle to post a 9.7% increase in earnings per share for the current quarter at $1.47, the company's expected growth isn't just optimistic, it's downright confident. The long and short of it, Oracle is a hot pick, promising robust earnings and fiscal stability, wrapped up with a pretty bow of positive market sentiment. Analysts, traders, and pretty much the entire financial market are chanting, "Go Team Oracle." After today, we might just start calling it Oracle Bliss. Hey tech enthusiasts, today's buzz revolves around the tech giant with a capital M and a capital Microsoft. Yup, you guessed it right, Microsoft. First up, Microsoft has brought down the house, virtually that is, with the highly anticipated announcement of Wave 2 for their Microsoft 365 Copilot. And it's not just a small ripple, we're talking a full-on tsunami here. Satya Nadella, Microsoft's CEO, laid down the big news during a live-streamed event where he highlighted that nearly 60% of Fortune 500 companies are on board the Copilot train. If that's not a seal of approval, I don't know what is. Wave 2 is jam-packed with 700 product updates, and they're already ramping up performance screws by moving to the GPT-4o model. If that doesn't get your geek radar beeping, I don't know what will. These updates aim to unify work, web, and pages into one magnificent orchestral harmony. Copilot now integrates deeply with your favorite Microsoft apps like Excel, PowerPoint, Outlook, and OneDrive. Imagine having an AI buddy seamlessly guiding you through Excel formulas, finding that one email in your stuffed Outlook inbox, or even spicing up your not-so-imaginative PowerPoint presentations. The impact? It's big and getting bigger. Nadella revealed that Copilot usage has nearly doubled quarter over quarter. Mega corporations like Vodafone are all in, having scooped up a whopping 68,000 licenses and reporting that their employees save around 3 hours a week. That might not sound like much, but over time, that's a whole lot of stress-free Sunday afternoons right there. Legal teams are saving an hour on contract drafting, while companies like Honeywell report saving 390,000 hours a year. Financial institutions like the Bank of Queensland and marketing teams from firms like Finastra are also reaping the efficiency rewards, big time. But that's not all, folks. Microsoft isn't just riding on the accolades of Copilot's success. They're pairing up with first-source solutions to up the ante on AI and digital technologies. Utilizing Azure OpenAI service, this collaboration aims to deliver cutting-edge digital transformations across various industries. Think generative AI solutions and multimodal, multi-channel search experiences that make enterprise data more accessible and useful than ever. To top it off, let's talk about how Microsoft stacks up against its competition. Based on a recent comparative study, it appears Microsoft is not just waving the flag but sprinting with it. Their relatively low price-to-earnings and price-to-book ratios hint at potential undervaluation, making it an intriguing prospect for investors. Their impressive EBITDA and robust revenue growth outshine industry averages, despite having a slightly higher price-to-sales ratio, suggesting they are rolling in profitability. Their financial stability is palpable too, with a debt-to-equity ratio signaling a balanced approach between debt and equity. Overall, Microsoft comes out on top among its peers with lower debt levels and higher operational performance. If you're invested in the tech sector, these numbers are certainly worth your close attention. There you have it, folks. Microsoft is not just coasting along, but continues to innovate and dominate with significant updates, powerful partnerships, and solid financial standing. If you've had any doubts, today's news should erase them. Microsoft is very much in the game and upping the stakes. All right, tech fam, let's dive into why Apple is all the buzz today. Buckle up because it's a mixed bag of news, and it's not all sunshine and rainbows for our Cupertino giant. First up, Apple's shares took a bit of a nosedive in Monday's pre-market, dropping 1.93% to hit $218.20. Before you break into a sweat asking Siri what's going on, let's break it down for you. One of the major factors here is the softer-than-expected pre-order numbers for the iPhone 16 lineup. According to analyst Ming-Chi Kuo, who, let's face it, has a pretty good track record for these things, pre-orders for the iPhone 16 series clocked in at about 37 million units. That's a 12.7% dip from the iPhone 15's first week pre-orders. Ouch. The main culprit behind this slow start? Kuo points the finger at the iPhone 16 Pro and Pro Max models, which haven't quite hit the mark. These models were supposed to dazzle us with Apple Intelligence, that fancy new AI software. But guess what? It's not available at launch. Lols, right? It's like ordering a pizza and only getting the crust. Plus, let's not forget the intense competition Apple faces in the Chinese market from the likes of Huawei. But wait, there's more. China's economy, a key market for Apple, is still showing signs of slowing down. So the combo of lukewarm Pro models and market competition is making investors a bit jittery. Some are even thinking of shifting their investments away from tech stocks if the Federal Reserve considers a rate cut. So yeah, All this has our beloved AAPL stock looking a bit like a roller coaster right now. On the subject of Pro models, it doesn't help that Apple just announced a $20 hike in the battery replacement cost for the iPhone 16 Pro and Pro Max models, bringing the total to $119. Yes, you heard right, it's like they're charging us for the negative vibes too. Meanwhile, the Standard and Plus models' battery replacement costs remain unchanged. So if you opted for the fancier model for the sleek new features, brace yourselves. Oh, and by the way, if you were already peeved about last year's price bumps for out-of-warranty devices or the cessation of coverage for hairline cracks, well, it's another reason to give Apple the side eye this week. All right, now for the fun part. What do you think about all this? Are you sticking with the iPhone despite these hiccups, or is Android starting to look a bit more tempting? Do you think Apple's foray into heavy AI is going to pay off in the long run, or is it all just a load of hype? Drop your thoughts, rants, and genius ideas in the comments below. I'd love to hear from y'all. Stay tuned and keep those gadgets charged. All right, tech friends, let's zoom in on Oracle today. Given all the noise Oracle's been making, it's impossible not to talk about whether it's a buy, hold, or sell, right? Spoiler, I'm leaning towards a buy on this one. But don't just take my word on it. Let's break it down. First off, Oracle's stock has seen some significant love from Wall Street lately. Analysts from Melius Research and Jefferies upgraded their outlooks and price targets, with projections climbing faster than a SpaceX rocket. Melius bumped it to a buy with a $210 target, while Jefferies set their sights on $190. That's some confident analyst backing there. Financials? Oh, they're downright chonky. Their recent fiscal first quarter earnings report showed a surge in cloud infrastructure revenue by 45%, bringing in $2.2 billion. Overall, their revenue hit $13.3 billion, up 7%, and their remaining performance obligations skyrocketed 53% to a staggering $99 billion. If that's not impressive, I don't know what is. And the options market, oh boy, it's buzzing like a hive of caffeinated bees. Bullish moves galore have been spotted, hinting that major market players are riding high on Oracle's promising future. They're projecting price ranges between $130 and $230. For the uninitiated, this is Wall Street's version of jazz hands. The Zacks indicators? Oracle is treated almost like a tech stock royalty over at Zacks, with their shares surging 17.9% in the past month while dwarfing competitors and even the S&P 500. The earnings per share are expected to rise by 9.7% this quarter. So yeah, it's not just a fluke. These are consistent, solid numbers. Add to that their market dominance with their 430,000 customers, and Oracle isn't just part of the tech conversation, it's leading the dialogue with a megaphone. Compared to industry averages, Oracle's continuing to impress on numerous fronts, be it their revenue growth, profitability, or those juicy future-forward partnerships and technological innovations with AI. So what's the bottom line here? If you're looking for strong fundamentals, innovative enterprise cloud solutions, and market validation, Oracle seems to check all those boxes. And then some. Hence, I would rate Oracle as a buy. But hey, always remember, while everything looks great on paper, it's vital to do your own research before making any investment decisions. It's your hard-earned money, folks. So consult with a financial advisor, deep dive into multiple sources, and happy investing. All right, folks, what a whirlwind of tech news today. From Accenture flexing its digital muscles and juicy dividends to Oracle regaining its mojo and skyrocketing stock targets, we have Microsoft dazzling us with massive updates. And let's not forget Apple taking a hit over iPhone pre-orders and some price hikes. It's been a day of highs, lows, and everything in between. If you loved today's updates, don't forget to smash that like button, subscribe, and share this video with your fellow tech aficionados. And be sure to join us again tomorrow for another action-packed tech news roundup. Stay tech savvy.